Hello everyone, I'm Dylan Silbernagel, and today I am joined by one of my favorite allied real estate partners, Nicole from Mortgagees, one of our favorite mortgage brokers who not only helps us in our coaching program with all the other agents that we're introducing, but also some of our fantastic clients. And Nicole, you and I go way back to a couple of transactions earlier this springtime that we had a lot of fun working on together, and you wowed our clients. So first of all, I always want to say thank you first for your time and for how you help our clients. And today is all about helping our clients a little bit more. We want to talk a little bit about some of the tips and tricks and strategies that you are sharing with clients today. And, honestly, what first comes to mind, of course, is like the refinances that are going on right now. But let's pull it back just for a second. Tell us a little bit about yourself and just in general how you're helping people in today's world, because it's one that we haven't been in a while, and it's a little bit different than some of the past times our market has been this way.
100%. And it's thank you for having me and that warm introduction. And yeah, I think right now, like, there's just a lot of uncertainty out there. Like you mentioned, this is not, we really haven't been here before. And so I think I can't emphasize enough that for clients, this is where you want to, get in touch with a finance professional to really make sure that you're understanding everything that's happening right now. So for, whether or not you're going into, renewals and we're looking to refinance, there are just so many things that we want to take into account and factor in. So this is where, be proactive, speak to, a mortgage professional. And for those refinances and those of you coming up with, with renewals, typically you can look to structure whatever that's going to be for you about 3 to 4 months in advance prior to your renewal, but speak to somebody, even if it's 6 months before, to make sure that you're really sort of understanding what that looks like.
I love that. Well, I'm going to jump in real quick because what I want to say is that's something that us as realtors have a discussion a lot with our clients. It's in your best interest to start planning early. Those that can take advantage of opportunities in the market, they do so because we've had a consultation early on. So you're not trying to get your ducks in a row when the opportunity arrives, but when the opportunity is there, you're ready to take advantage. And it's the same thing on your end.
Exactly. 100%. Like I always say, it's never too early. Like, you want to make sure. And to that point, like you want to be able, especially right now in the current environment, like as an opportunity pops up, you need to be able to jump on that. Right. And we need to make sure that we have our ducks in a row prior to doing that. And everybody's situation looks, a little bit different. We've got people who are looking to maybe restructure debt and are looking at things from a cash flow perspective and making sure, how do we handle that? We also have a lot of clients right now that, are still looking to take advantage of various opportunities out now, like that are still out there right now, right? So how do we take advantage of that? We have to be prepared.
Yeah, I love it. Okay, so what are some tips that we can give to people today in terms of something that they can work on, whether they're getting ready for a purchase or what's a refinance that we talked about, or maybe it's just a renewal that's coming down the pipe? Where do you want to take us today for our discussion?
So right off the bat, I want to highlight variable rates. And I want to just start by saying I think the variable rates have had a really bad reputation for quite some time, and understandably so. We came out of significantly, increased rates happening very quickly, very rapidly, and a lot of fear surrounding that. So, I'm not taking away from that, but I want to say that right now, we are expected to be in a declining rate environment. Wherever ultimately those rates are going to take us, nonetheless, we think that we are going to continue to, be in that declining rate environment for at least probably the next 6 to 12 months for sure. Mm-hmm. So that being said, I want to remind everyone that with variable rate, although variable rates are sitting higher currently than fixed rates, the variable rate will buy you the flexibility of being able to lock into a fixed rate at a later date, whether that's 6 months, a year down the road, regardless of where you want to lock in, it will give you that flexibility. So even if clients come to me, and whether you're looking to purchase, to renew, to refit, any of that, the same still applies. If you would prefer the peace of mind of a fixed rate because you want that stability, again, the variable rate is not, the suggestion is not to go into that variable rate and ride the wave again and stay there. It's that if we think rates are going to come back down, because remember, the decreases that we're seeing with the Bank of Canada, the fixed rates are not directly correlated to that, right? So it's going to take some time before we see that trickle effects in the fixed rates come back down to where we think they're going to stay anyway. So, if we want to buy ourselves some time, lock into a variable rate now, and then that can give you the flexibility to lock into a variable rate now. It'll give you the ability to lock into a fixed rate later on, right? And so if you're looking to, kind of go back to that standard fixed term, for example, you can lock into a 5-year fixed rate at maybe 3.5% a year from now, or 4% rather than, 4.5% or 5% right now, right? And that will typically offset. So it's not that it's a matter of right or wrong. It's a matter of, it's a strategy that I definitely would look at for almost everyone, right? Ultimately, to see if they can qualify for that and to buy themselves that flexibility.
And so if I'm going to simplify that a little bit, let's say that I have to refinance today, or I'm making a purchase today to take advantage of the lower prices, but the fixed rates are still higher than I believe they're going to be 6 months from now, right? Or where they're going to be 3 months from now, but I want to make that purchase today, or I have to make that refinance today. What you're talking about is using the variable rate so that you don't have to lock in at that higher fixed rate now and then pay a penalty that is so big that it doesn't make sense to break, in comparison to okay, I can take the variable for the short term, then lock into that 5-year fixed when the rates come down to where I'm happier, where they're at that lower amount, and then carry on my fixed rate instead of being on the variable.
You got it, exactly. And ultimately the numbers should really work in your favor, right, with that as well too, with respect to interest. Because again, for very easy numbers, let's just say that variable rates are sitting at 5.5% right now, in 6 months from now or a year from now, you're locking into a fixed rate at, like I said, 3.5%, for example. Well, that difference, and if you're locking into that for another 5-year term, for example, that difference will definitely save you very likely lots of money in interest and over time, right? So you can still have that peace of mind of exactly what you're looking for by just kind of hedging early on with a variable rate.
Right. Now, we talked a little bit about a cascade strategy before. Am I getting ahead of myself, or where do you want to go to next?
No, I love it. Let's do it. So this is the perfect segue into different strategies. So in terms of there's you can kind of see here, I've got sort of 4 different strategies that we can or 3 or 4 different strategies that we can look at right now. So that dual flex one is kind of what we just talked about, right? It's about the fact that you may love the idea of the fixed rate, but again, you want to buy yourself the flexibility, right? So that's what we just kind of talked about. You lock into a variable right now, and then you can kind of, have that dual strategy where you lock into a fixed rate later, and it ultimately offsets each other. The cascade strategy is more so, again, it's pertains to the economy and the environment right now with respect to a declining rate environment. So what that would look like, and this would pertain to people who are looking to sell and buy. So if you're looking to purchase, I say sell and buy because this will work if you have a lot of equity in your house, right? So typically a sale and a buy, or it could just be somebody who's purchasing as well, but has a larger down payment. So something more than the average 20%, because ultimately you want to take advantage of the equity in the house to add on a home equity line of credit. So with this strategy,
I'm gonna jump in before you keep going. To help people kind of identify themselves there, one of the big opportunities in this market as it's come down, as sales have dropped and pricing has adjusted, we're down about 19% in terms of average price from the peak of the market to where we are now. Now is one of those great times to make a move up. So if you're already established in your house, you're in a townhouse and you want to move up to the detached, or you're in a detached and you want a larger home, you need the 4th bedroom, whatever it might be, as the markets come down, those higher priced homes have been hit harder than somebody that's at the category below it. So it's a great time to take advantage of that move up before the market turns back around and gets as hot as we don't know what that's going to look like. It's not going to be what it was because our interest rates are not going to get that low again. But at the end of the day, the GTA housing market has been so resilient. Every time we're in one of these tough markets, it feels like it's lasting forever, and then a blink happens and we're like, what is going on with house prices again? They're back up. So as that turns back around, it will be harder. That gap from where you are now to where you want to be will be larger. But right now it's a little bit lower, but we know we've got equity in the home. So what Nicole is talking about is a strategy where you can use that equity to help buy up and not have the downside of the higher rates, or at least mitigate the higher rates that we're in because we are declining. So Nicole, I'm going to throw it back to you. Talk to us a little bit how we would take advantage of what you're talking about, knowing that today, yes, I can make a good buy, but the rates are a little bit higher than I want, and I know they're coming down.
Exactly. So that's the perfect sort of introduction to that. And so let's roll with that and let's stay okay. Hey, so now we're going to to purchase, let's say, for example, again, or it could be your renewal or refinance. Let's just use very, very easy numbers. So let's just say ultimately we've got a home that's worth $1 million. Let's just say, for example, again, easy numbers. We've got a mortgage that's $500,000. So you can, with this cascade strategy, and again, being in a declining rate environment, I can, instead of just taking a mortgage and putting a regular mortgage on for a client of $500,000, I can restructure that mortgage so that I can, let's just say, we'll put them in $300,000 of a regular mortgage. So a regular term, we can do a 3-year fixed if we want, whichever term you like. But we have $300,000 that's in a fixed portion. Then we're going to put on the same level of debt, but we're going to put on a $200,000 HELOC, so a home equity line of credit. So ultimately, it's still that same $500,000, right? But we're just structuring it differently. Then let's just say, for easy numbers, let's just say we have a 5% rate for that term portion. With the cascade strategy, what you can do is you can take advantage of prepayment privileges. So this is where I want to emphasize and really, really highlight to everyone that lenders and products matter. So I know we're all sort of really fixed on the rates themselves, but if you have a lender that is offering 10 points lower than, let's just say, a lender that's offering 4.8% instead of 5%, okay? But they're only offering 10% prepayment privileges. A lot of people will just ignore that because they're going to say, hey, Nicole, I don't really care about the prepayment privileges that much because I don't have, 10% of the loan amount to prepay anyway. So I don't really care, for lack of a better way of saying it. Please do care, because it's important. Because with that 10%, like I said, don't think of it in the sense of I have to have cash in my pocket. We can go to another lender that's going to offer you 20% prepayment. And going back to the strategy that we're discussing, what we're going to do is, with that 20%, for the $300,000 term portion that we have, before your renewal, let's just use Scotiabank for an example so that we're all kind of really understanding how this works. Scotiabank will allow up to 20% if it's negotiated in terms of prepayments. So we're going to take the prepayment privilege, and because we have a $200,000 home equity line of credit, we don't have to have that 20% in our back pocket or sitting under our mattress. We're going to use that home equity line of credit, and we're going to use our prepayment privilege of 20% to prepay into our mortgage, that $300,000 mortgage. And so let's just say that's what, $100,000. So let's just say now that we've done that before the renewal date, the anniversary date, and that's 20%. Let's just say the anniversary is on November 1st. Okay, so we've got 100,000 sitting in our home equity line of credit, prepaid. Now our other mortgage is 200,000. The following month later, it resets again, right? Because now you've got another 20% prepayment. You're going to use that same home equity line of credit to do another 20% because it resets again. So now you're going to have a total of 200,000. And again, same amount of debt, right? Because we're just going to use that to pay down the 300,000. Except now it's been over a year and we expect that we're in a declining rate environment. And now instead of 5%, we've got rates at 3.5%, let's even be conservative and say 4%. So now you're going to lock that in to another fixed term, because we don't want to keep it in the home equity line of credit because that's a higher interest rate. We want to lock in and take advantage of the lower rate. So now you've got the same level of debt, right? Because now you've locked it in, but you've got a portion of it at 5% and another portion of it at 4% or 3.5%. So ultimately, you're paying way less interest with the same level of debt. And I'm going to say one more thing because I know this is a lot. What you can do specifically with Scotiabank, sometimes other lenders will allow it, but it's part of Scotiabank's policy, that you can then stretch out. You can call up Scotia and you can say, hey, Scotia, I'd like to amortize my payments because I've put down 40% now. So for people who are really concerned about cash flow and affordability per month, you can now take that same amount and re-stretch it back out to your original amortization to make that monthly payment lower. If you're not worried about cash flow, not a big deal. You can just keep it as is, right? But ultimately, so you can take advantage of much lower interest rates. Overall, your effective interest rate is much lower, right? Because you're getting the same level of debt. And so it works with refinances, renewals, purchases, any of that, as long as you're following that strategy.
Yeah, and so this is something that you guys have evaluated and looked at. Hey, we know that this is a challenge as people are like looking at it and being like, I've got to refinance now, but I know it's going to be better in 6 months because we are declining in these rates. What do I do? And what you have here is a solution for that. And so I know the financial side and the numbers can easily make people glaze over just a little bit. What's important to note is that you can always call up someone like Nicole or Nicole herself and have these discussions in person where you sit down and you look at your numbers and look at how it would all pan out after that first prepayment, after the potential second prepayment, and now you're buying down at a lower rate instead of what you might have to pay today. And I think that that's so important.
And ultimately, that's what it comes down to. Because, like I said, I know what I'm saying. It's a lot. It can be a little bit overwhelming. But if you're remembering anything, it's that there are strategies to take advantage of a declining rate environment, and things like your prepayment privileges and having access to a home equity line of credit or the overall products really do make a difference in terms of what you can achieve and how you can achieve certain goals. So I just implore everyone to really pay attention and to speak to somebody so that you could take advantage of something like this rather than just paying attention to the lowest rate, for example.
Yeah, and it's tempting. I think a big reason why a lot of people are tempted with the lower rates is because, hey, I don't have money to make those prepayments right now. I understand the concept of if I don't make any prepayments, I'm spending a lot of interest on this mortgage over the full lifespan of it, and that sucks, but I don't have the cash to do it. And then here's another option that people aren't aware of and how you can do it. And I think at the end of the day, to get ahead in our world these days is you need to take advantage of many of these opportunities as possible. Because if you just follow the normal trend, you're spending so much money in what that is.
And, ultimately, what I'm sharing with you guys right now, you're not going to hear that if you walk into the bank. The bank is not going to teach you to say, okay, hey, take advantage of this so you can make sure you're getting the ultimate lowest rates. Like, they're relying on individuals to just pay attention to that rate. And like in the example that I gave you guys, and of course anybody who wants to see the actual numbers, I'm happy to chat and show that to you so it makes more sense. But ultimately, in that same example, that 4.8 interest rate versus the 5% that I gave you an example of, when you actually look at those numbers that I gave you broken down over that time, the interest rate ends up being significantly lower because of that weighted average, right? So, but again, people are not going to think of that right off the bat. They're just fixated on, okay, hey, let me make sure I'm getting that that lowest rate up front. And this is where the information is there to help everyone. It's just take advantage of getting that information out to you.
Yeah, so the two main points that I've heard so far is, of course, starting your consultations early. Find out what options you have available to you, whether you're getting ready for a purchase or it's a refinance or a renewal. What options do we have? And the earlier you check that out, the better, the more chance at opportunity you will have. And the reason I want to highlight that as well is, Nicole, on a bunch of our calls, we've talked about how banks, as we're now in this declining rate environment that we've said so many times, banks are limiting what their discounts are on some of those rates. But if you'd been talking to Nicole earlier and locked in some of those discounts that they had available, now you get the lower rate and you get the bigger discount, but now those discounts are drying up. So again, it's a perfect example of why we want to talk to somebody early, because we don't know what opportunities are out there until we have that conversation.
100%. Yeah. You nailed it. You don't need me anymore now.
Yeah. So the second point that we talked about there is obviously the prepayment options that you do have. And again, I think it's something that you do need to have a conversation with someone like Nicole to make sure you understand the numbers. You need that broken down for you. And then finally, I would say, Nicole, what's the third and final tip that you want to leave with homeowners or potential purchaser these days that can truly benefit them for their outlook going forward?
I'd say it kind of ties into those renewals and refinances and things like that. Because, I know that just with coming out of the last few years that we have, there's a lot of clients out there that are, sitting with a lot of debt and things like that, and looking to consolidate that. You'd be surprised at seeing, for those of us who have, some credit cards or lines of credit or things like that we're managing, and maybe you don't necessarily think it's a problem, but when you look at what those interest rates are versus rolling that into your mortgage, even if rates are sitting a little bit higher than, we ideally want them to be right now, those are typically much, much lower than anything that you're seeing on like a line of credit or a credit card. So anybody who's looking and kind of dealing with something like that, just reach out to your financing partner or somebody to make sure to see what that would look like to consolidate, because doing that and being proactive with that as well too is going to help you, especially if you're looking to upsize, because right now we said that there's a lot of advantages in terms of selling and purchasing. So let's look at cleaning that up sooner rather than later, so that we can put you in a good position or a much better position to be able to potentially qualify for what you're looking for later. Or maybe it's just a matter of your renewal, but we're looking to take advantage of consolidating that, because a lot of people don't necessarily realize that would help you by rolling that into your mortgage.
Yeah, and I think that it's important that we note that we're coming up to that time frame where people were being offered the lowest rates possible, and we're buying at a time when the housing prices were at their highest. Right,
100%.
So all those people that are coming up on those renewals, it will be the most challenging time. And we just want you to know that you're not alone, that there are professionals out there to help you, because it is an important thing. We talked about this on another call, Nicole, about the anxiety that comes along with some of those renewals, because we are seeing almost double in terms of like the interest rate that they will be facing now compared to what they were when they purchased. So yeah.
And there are ways, like we talked about this earlier too, like where, for people who are dealing with that, double, triple payments, and they're dealing with that anxiety around, cash flow, our goal is to make sure that we're able to keep people in their homes and maintain affordability, right? So we can look at things like stretching back out your amortization and making that payment a little bit more comfortable for you. And people will say to me, but aren't I working backwards? Because ultimately I'm supposed to be paying down my mortgage. Yes, of course, but we just came through some very challenging times. And so again, ultimately the goal is to deal with the challenge that we have at hand, which is helping you with that cash flow. And the nice thing about, Canadian financing is that although we have these 25 or 30-year amortizations that are ultimately the life of the mortgage, we have the ability to renew our terms every, on average 5 years, sometimes even less than that. And so we can stretch back out your amortization now to help you feel more comfortable. And then guess what? 3 or 5 years, from now when we do that renewal again, well, we can kind of work backwards and take you back to where you would have been, so you can catch up, so to speak, right? So I just implore clients not to get too worried about that, because let's just make sure we're dealing with what we need to at hand, which is to make people as comfortable as we possibly can and deal with sort of, what we've just been through over the last few years.
Yeah, I think that's important to note, that you got to remember that even some of these new policies that are coming out from the government in terms of stretching out that amortization, yes, we don't want to have longer amortization. We do know that there's going to be more interest over the term. But at the end of the day, if this is something that keeps you in your home or keeps you more comfortable for the time being, it can be a short-term solution. And the only thing that we always preface with that is, yes, it's great to have the option for a short-term solution. Just make sure you have an exit plan. It's the same when you're looking at B lenders. Jen and I, when we bought our first house, we went through a B lender. We had an exit plan. We got out of there the year later, and it was fantastic. And we never looked back. We're so grateful for having done it. But if we had sat there at the time and said like, hey, we don't want to do this because the option's a B lender, well, we would have missed out on so much equity growth. And I think that's just something that can't be overlooked. But you can be sticker shocked at the beginning of like, I don't want to do it this way because it means this. Well, it can be a short-term solution.
100%. And I love that you said that, because there's usually a solution for pretty much anything, right? And it just depends on, what you're looking to do. But especially right now, with the fact that people are so, again, fixed on rates, but they don't understand that from a price point perspective, there are a lot of really good opportunities out there. So to your point, choosing a B lender or alternative lender may be the deal breaker for you to actually be able to take advantage of something and get into the market. And if we have the ability to do that for someone versus not, and wait a year or two until maybe rates are a little bit lower, but at the same time price points are much higher, it's definitely worth chatting with somebody to see what we can do and look at alternative solutions as well.
Yeah, I think what I'm going to do when I upload this video is just make sure that we've got a chart there showing house prices over the last 25 years and show where we've had those blips and where we've had those tough times and what happened to the housing market afterwards. The GTA housing market is kind of relentless in the way it performs like that. And though these times are a little bit different, I think it would be silly to think that house prices aren't going to continue to go up over the long term. So if there is opportunity now, it's prudent to at least have a discussion about what you can do with it.
Exactly. And I'm always of the belief, regardless of what we're going through right now, like you can never really time the market no matter what, right? Like there's always going to be something. And so I always will say to clients, like, listen, like, what is the most important thing? Even when it comes to rates, ultimately everybody, is again, wanting to make sure they're getting the lowest rate, but ultimately it comes down to, what is your monthly comfort level, like in terms of affordability, right? So regardless of what the rates are, how do we make that work for you? And how do we achieve that goal regardless of the other external, circumstances? Let's just focus on that.
Awesome. Well, Nicole, I want to thank you so much for donating your time today and coming on and sharing some of that information with us. I really appreciate it. And
Anytime.
I'm going to have your contact information up there if anybody's looking for some advice or just an additional consultation. Nicole is fantastic, and I'm sure we'll be glad to sit down with you. And we
Always happy to help.
Yeah, and we look forward to seeing everybody next time. Take care and bye for now.
Bye, guys.